Every day on Faith and Finance, we hear from believers who are trying to follow Jesus faithfully with their finances. They're not calling for quick fixes. They're looking for biblical wisdom they can trust. Because of faithful partners, FaithFi reaches millions through radio, books, and the FaithFi app, helping people see that money issues are really hard issues, and God's wisdom changes everything. When you support FaithFi, you make these conversations and transformations that follow possible. With a gift of $35 a month or $400 a year, you help sustain this ministry and receive ongoing resources to support your own stewardship journey. Visit faithfi.com/give to become a partner. That's faithfi.com/give. What if investing wasn't just about returns, but about redemption? Hi, I'm Rob West. For many of us, investing can feel impersonal, something tied to markets and retirement, not spiritual formation. But Scripture calls us to something deeper, using what we have to serve others and reflect God's purposes. Today, we'll explore how investing can become an act of worship and a tool for human flourishing. And then we'll take your calls at 800-525-7000. That's 800-525-7000. This is Faith and Finance, biblical wisdom for your financial journey. In Colossians 3:17, Paul writes, "Whatever you do, do everything in the name of the Lord Jesus." And that includes investing. There's no sacred, secular divide. Every financial decision becomes an opportunity to honor God. From the beginning, God called His people to steward His world. Investing is one modern way we do that, directing resources into productive work that serves others. Done rightly, investing becomes a way to advance the goodness of God's world. And that aligns with Jeremiah 29:7, where God calls His people to seek the welfare of the city. Even in exile, they were to pursue the flourishing of the place where God had sent them. That mission still applies to us today. When we invest wisely, we're not just growing assets. We're resourcing businesses that create jobs, meet needs, and promote dignity, justice, and opportunity. In that sense, our portfolios can direct resources to help people and communities thrive. Now, Christians approach this in different ways. Some choose to avoid certain industries altogether. Others engage with companies as shareholders, encouraging positive change. And others seek out investments that intentionally promote human flourishing, whether through community development, innovation, or ethical business practices. But wherever you land, we can agree on this. Investing is a meaningful expression of stewardship, and it begins with the heart. Faithful investing doesn't start with strategy, it starts with surrender. Lord, what would you want me to do with what you've entrusted to me? That posture transforms investing into worship, but it also becomes a witness. It shows the world that we're not living for accumulation, but for something greater, that our financial decisions are shaped by faith, not just profit. So what does this look like in practice? Well, first, begin with prayer. Invite God into your investment decisions. Ask Him not only for wisdom and discernment, but for a heart that desires what He desires. Second, evaluate your portfolio with intentionality. Don't just ask how it's performing, but what it's producing. Are your investments reflecting your values? Are they contributing, even in small ways, to the flourishing of others? Third, think beyond avoidance. It's good to be mindful of what we don't want to support. But don't stop there. Ask how your capital can actively serve the common good. How can your investments reflect God's character, His justice, His generosity, His care for people? And finally, seek wise counsel. Proverbs 11:14 reminds us, "In an abundance of counselors, there is safety." That's why I encourage listeners to connect with a certified Kingdom advisor, someone who shares your faith and can help you align your financial decisions with biblical wisdom. You can find one near you at findacka.com. Now, it's important to remember investing isn't just about preparing for your future. It's about participating in God's work right now. In Galatians 5:13, Paul writes, "Through love, serve one another." Investing with a biblical perspective allows us to do exactly that, to use what we've been given to serve others in love. So the next time you review your portfolio, don't just think about growth, think about grace, think about generosity. Think about faithfulness, because when we invest with eternity in view, we intentionally direct our resources toward the flourishing of others. We're not just allocating a portfolio, we're participating in God's redemptive work in the world. Jesus said the greatest commandment is to love God and to love your neighbor as yourself. Investing with purpose is one way we live that out. It's how we turn capital into compassion, assets into action, and freedom into faithful service. So invest with wisdom, invest with worship, and most of all, invest with love. Because in the end, it's not about how much we've accumulated. It's about how faithfully we've participated in what God is doing in the world. If this idea resonates with you, I'd love it if you checked out my new devotional, Our Ultimate Treasure, a 21-day journey to faithful stewardship. You can get your copy today at faithfi.com/shop. That's faithfi.com/shop. And if you want to walk through it with your church or small group, we offer bulk discounts as well. All right, your calls are next, 800-525-7000. We'll be right back.
Are you a financial professional looking to grow your practice while offering advice that aligns with your Christian values? By becoming a certified Kingdom advisor, you'll gain the biblical wisdom and professional credibility to serve clients who are seeking faith-based financial guidance. Each year, more than 75,000 people search for a certified Kingdom advisor. Join our community and share your expertise with clients looking for someone who shares their faith and values. Start your journey today by going to kingdomadvisors.com/get-certified.
We are grateful for support from Movement Mortgage, who provides residential home loans and reverse mortgage options in all 50 states. Guided by a mission to love and value people, Movement seeks to help individuals and families make informed financial decisions, from buying a home to planning for retirement. More information is available at faithfi.com/movement. Movement Mortgage LLC supports equal housing opportunity. NMLS number 39179. For licensing information, visit nmlsconsumeraccess.org.
Thanks for joining us today on Faith and Finance. Taking your calls and questions. Let's go right to the phones. Out to Illinois. Lisa, go ahead.
Yes, hi. I was just calling in reference to a gentleman that's 86 years old, and he was told probably years ago that he couldn't get Social Security, and he worked for a company for years and had, a pension from them. And I don't think that's true, and I just wanted your take on that.
Yeah. Let me just be clear. So having a pension does not automatically disqualify someone from Social Security. However, there are a few situations where benefits can be reduced or sometimes are not payable. So when someone with a pension might be told they can't get Social Security, that would be related to whether or not Social Security taxes were paid. So if someone worked in a job that did not pay into Social Security, then that would mean that there was no Social Security payroll taxes taken out because they were in a non-covered employment. So certain government jobs or railroad systems or some older corporate pension structures resulted in no Social Security taxes being paid, or if Social Security taxes were not paid long enough. So he's got to have what's called 40 credits, and you get a credit for every quarter that you pay in through the FICA taxes. So that would be basically 10 years. If you don't have 10 years where you paid into Social Security, then you would not be able to get Social Security benefits. But it's not the pension that's blocking the benefits. It's simply that you didn't pay in to Social Security long enough. The other two situations are something called windfall elimination, which is where you have a lower Social Security benefit calculation because of a certain type of pension or a government pension offset. However, those were repealed because of the Social Security Fairness Act, which went into law in January of 2025. That windfall elimination and government pension offset no longer apply, and a lot of folks are getting automatic increases in their Social Security benefits and even retroactive payments as a result of previously being subject to one of these, and now those no longer being in effect. So I think it ultimately comes down to just whether your friend ever paid into Social Security, and if so, did he pay in long enough, meaning did he have 10 years of FICA taxes withheld? And the best way to determine that is to go to myssa.gov and log in online, or have somebody help him do that, maybe you, and just pull up his benefit statement and find out exactly what the situation is. Does that make sense?
Yeah, and that was myssa.gov.
Yeah, SSA standing for Social Security Administration, myssa.gov.
Okay, thank you. So you're saying that if it was a government, because I know Kat does a lot of government work, but I don't know who paid him. So if it was that type of thing, sometimes it can be retroactive, so it can go back to where he was 65?
Well, it really just all depends upon, did he have enough qualifying payments into Social Security? So if he was a W-2 employee, what happens is, as that money is paid to him, the employer would have their portion of Social Security, half of it, and then he would have his portion. And generally that comes out automatically and gets paid into Social Security as a W-2 employee. If you're self-employed, which he was not because he worked for Caterpillar, then you would pay the whole Social Security FICA taxes on your own, that 15+%. But the key here would be, did he have those taxes withheld based on the type of pension that was being offered to him? And that's where the Social Security Administration pulling that benefit statement would be the place to find out exactly how many credits he has by way of Social Security taxes being paid in. Let me also mention, it looks like they changed that URL. So if he just goes to ssa.gov and then clicks on My Account, that would be the place to go, ssa.gov, okay?
ssa.gov. You spawned another question for me. If the employer paid their part of the Social Security and he paid his part, and maybe he paid lower because he didn't, he wanted to keep part of the money that he might have, I don't know. If it even has to do with anything?
No, I mean, he would have been, the IRS would have reached back out to him, because generally the only way that happens is when you're self-employed. But otherwise, both sides pay in, and that's reported to the IRS, and it comes out of every paycheck. So that would not be the case. The only way that this would be possible is if he was in an exempt situation where, because of the pension, there was not, taxes paid into Social Security. And if that's the case, then he wouldn't get the benefit. So he just needs to go into ssa.gov, find out on his benefit statement exactly how many credits he has, and then that will tell him what he's entitled to, if anything. So I think that's the next step. Lisa, I appreciate your call today. If we can help further, don't hesitate to reach out. Jamar is in Arkansas. Go ahead.
Yes. I wanted to, kind of ask, do you give advice on, I had a situation that kind of came up where I had got behind on my bills or whatever. And I do work. I get paid maybe about $700 a week.
Yeah.
But some of my bills I kind of fell behind on. I wanted to know, is there some type of information that you could go out on, maybe getting with a company that has a lower APR? Because the interest is just tearing me up right now. And I reached out to a company, I think it's called National Debt Relief, and they said they could do it, but I just wanted to get a second opinion before I just jumped into something.
Well, I'm delighted you called, Jamar. Listen, you can do this. The starting point is to break this cycle of borrowing, and I realize that's harder than ever with expenses up across the board and you're dealing with 700 a week and trying to make it all work, but it's got to be in the context of a plan. So we've got to get you on a spending plan so you understand what's coming in every month, and then you give every dollar a job. We got to start with the big four, keeping the utilities and the lights on, keeping gas in the car to get to work, food on the table, and a roof over your head. But beyond that, everything else is negotiable as we right-size the spending so you can live within your means. As a part of that, we've got to get you moving toward paying this debt off once and for all. And you hit on something really important, and that is not only a payment that fits in your budget, but with lower interest rates so that you've got more going to principal reduction every month to get you on a path to get out of debt. But the key is, with that slow and steady approach and with that new spending plan, once it's paid off, we don't ever go back there again. And we take that money and roll it back into the budget, into building an emergency fund, maybe saving for the future. The place to go is ChristianCreditCounselors.org. These are believers. They've worked with thousands of our listeners. They'll do exactly what you need to do and help you set up a budget. Again, Jamar, ChristianCreditCounselors.org. God bless you, my friend. Back after this. Stay with us.
The freedom you're looking for may begin with one question: how much is enough? That's why we created the Faith 5-Field Guide, How Much Money is Enough, a scripture-centered resource designed to help believers just like you find contentment through biblical wisdom. When you become a Faith 5 partner by May 31st with a gift of $35 a month or $400 a year, you'll receive this field guide as our way of saying thank you. You can visit faithfi.com/give today. That's faithfi.com/give.
Faith in Finance is thankful for support from The Good Investor, a book by Robin John. In his book, Robin shares his journey from an immigrant child struggling in school to co-founder and CEO of Eventide Asset Management, a faith-based investment firm. This faith and work memoir seeks to inspire readers to view their work and investments as opportunities to honor God and bring blessing to the world. More information is available at goodinvestor.com. That's goodinvestor.com.
Thanks for joining us today on Faith and Finance. We're taking your calls and questions. If you've got a question, we'd love to hear from you. Call right now, 800-525-7000. Again, that's 800-525-7000. Whether you're thinking about paying down some debt, you want to give wisely, perhaps it's preparing the next steward, or choosing whether a will or a trust is a better option for you. Any of those questions and more, 800-525-7000. Let's go back to the phones. We'll head out to Tennessee. Gabriel, go ahead.
Thanks for taking my call. My question to you is, I own 3 properties, and they were purchased different times and in our lives with my wife, and 2 of them are rentals, and one is a residential property where we live. And because we own those 3 properties, now that we're trying to buy another property, they're telling us that we max out. Even though those 2 properties, we're getting some income, and they're kind of paying off the mortgage. But because they kind of mentioned that because they were not purchased through like LLC, it kind of limited us right now in purchasing land or other properties. So, what is your advice on what can we do to maybe getting opportunities or approval to get more loans to purchase other properties?
Yeah, it's a good question, and this comes up a lot with real estate investors. The first thing, though, that I would say, and this is really kind of the big idea that is overriding here, is that moving properties into an LLC is not mainly about buying more houses. It's usually about liability protection and organization. So lending limits typically come from the borrower's personal debt and underwriting, not simply whether the property sits in an LLC. A lot of people think by having an LLC, that equals more borrowing power, and that's just not simply true. The limitation is usually from your own personal debt to income ratio or the number of financed properties you have, because Fannie Mae and Freddie Mac have caps, or because you've gotten to the end of the personal guarantees they're willing to extend. So even if properties sit in an LLC, lenders are often still going to look at you personally unless you move fully into commercial lending. So it can help with liability to get an LLC, but it's not generally going to expand your loan capacity by itself. Does that make sense, though?
Yes, that's probably
Okay.
That makes sense.
Yeah. So I think that's what you're going to need to look at next. You certainly can keep the titles personally. A lot of people use an LLC for operations, because it helps to transfer some of the liability. And in order to do that, you do a deed transfer. Now, you've got to beware, though, that a lot of mortgages will have a due on sale clause. So that allows the lender to call the loan due if ownership changes. Now, many lenders will ignore a transfer into a single member LLC, which is what you would likely create, but not always. So you're going to want to talk to your lender first before doing anything in terms of transferring the property into an LLC if you go in that direction, just to be sure how they're going to respond to that. It also could mean higher interest rates, and there's stricter underwriting since they're typically considered commercial loans. There also could be some additional fees and taxes as well. So I just want to make sure you get with the CPA and you talk to your mortgage lender and understand all the implications. But moving in that direction, I think, is a better long-term strategy for you because it's going to allow that liability protection and allow you to have better organization of the rental property business that you're running.
Right. And those two properties right now, one of the things that we look at the interest rate are 3.9 and 4.0. Transferring that to LLC might change that.
Which are phenomenal. Yeah, you're not going to get anywhere close to that now. So I think you're probably going to want to hang on to those as long as you can, because those rates are certainly going up no matter what change you make, unless the lender is going to allow you to just continue on with the current mortgage, even though the ownership structure is going to change. But I wouldn't risk that. That's why you'd want to have a pretty lengthy conversation with them and be assured that you can continue with that mortgage even if you move into the LLC. But I just want you to consider the fact that it's probably not going to open up more borrowing power. It could just simply be because the lenders are looking at you as really the personal guarantee for these, that you've gotten to the end of what they're comfortable extending to you, until we move more into a commercial loan situation. So I'd probably ride these out as long as you can. Maybe you try to focus on, taking all that rental income that's being thrown off and try to get one of those paid off as quick as you can. And then that might open up the possibility of acquiring an additional property. I'd certainly be more comfortable with that approach as well. So, Gabriel, I hope that gives you a few things to think about. We appreciate you being on the program today. Call anytime. All right, let's head to Akron. Hi, Joy. How can I help you?
Hi, Rob. I have a question about an inherited IRA.
Yeah.
My husband inherited 2 IRAs from his mom, who died in 2020. We haven't taken any distributions yet. And I know that Secure Act, is now you're required to withdraw it all within 10 years.
Right.
And so my question is, are there advantages to starting to withdraw it, or is it better to just wait and do like a lump sum withdrawal?
Yeah, it's a good question. And, I like the idea that you'd leave it in there as long as you can, because if you guys don't need this money, I'd rather it stay in the tax-deferred environment and you take out as little as necessary, and you could talk to your CPA about what that is. You are correct about the Secure Act mandating that non-spousal beneficiaries, which you and your husband, of course, are, have to be withdrawn from the inherited IRA within 10 years. But in that tax-deferred environment, especially with it invested, I'd love for you to keep that money growing for you and then just take it out as you need to. And then at that point, we've got to figure out kind of where to put it. You're going to have to pay the tax on it. So now it would be after-tax dollars. And then you could turn around and continue to invest it in a taxable environment where you're paying capital gains each time you have an appreciated stock or bond that's sold. Or you could try to, funnel it into a Roth IRA or, some other vehicle. But I think to answer your question, I'd try to leave it there as long as you can.
Okay. All right.
Yeah.
Thank you.
All right. You're welcome. Thanks for your call today. We appreciate it. Big thanks to my team today, Josh, Jim, Omar, Tahira. If you want to support us, become a partner at faithfi.com/partner. We'll see you next time.
Faith and Finance is provided by FaithFi and listeners like you.